All right, good morning, everybody. Seems like I'm a little late. That's what happens when I wake up early. I get started on a project and then lose track of time. All right, so a little bit of headlines this morning, and it's always one of the things we focus on, but something I rarely talk about, mostly because the headlines don't have enough to last. But as a part of the morning briefing process where I'm trying to teach these steps of how to prepare for your trading day, you want to look at the news, not just reactionary of, this thing happened and now it's going to affect the markets, but we're looking for the bigger news, the news that might linger for a while and actually change market structure or market sentiment for an extended period of time. And usually the example that I use is, say when that ship got stuck in the canal. It didn't really seem like much at first, but the longer it was stuck, the more it affected shipping lanes, and it just became this bigger and bigger and bigger thing. The crypto contagion is becoming part of that. It's starting to bleed over into other markets, into everything, really. At the start of 2022, when people were looking for an alternative hedge, hedging against inflation, hedging against a market downturn, looking for a way to move money out of, say, technology or even out of equities altogether, a lot of firms, they can't go to cash. They would pay such an enormous fee for sitting in cash that they're better off actually taking risk somewhere. Because if you have to face investors and tell them, well, we spent a lot of your money on fees, an exorbitant amount of money on fees, taking no risk whatsoever, we just lost your money from fees. If you have to do that, you're probably going to lose your customers. But if, on the other hand, you at least attempted to make your clients money, then if you lose, well, you can say it's a part of doing business. So at the start of 2022, when they were looking for hedges against inflation and hedges against a market downturn, a lot of firms and institutions were moving through out of equities and into different products. Bitcoin, or blockchain, not Bitcoin, but blockchain products, continues to grow. It's something that a lot of firms are focused on. And if you look at the crypto list that I use, it has things like PayPal, AMD, NVIDIA, Riot, and these might not necessarily be names that you would think of automatically as, quote, crypto names, but they are a part of that space. The problem right now is places like, say, Valero are getting whacked because they were heavily vested, right? So this contagion can go into really obscure places that you wouldn't think crypto contagion would go on first glance. So it's something I can't stress enough. Read more about it, right? One of the things that you learn as you get deeper into trading, hopefully you learn, right, is that you don't know everything. I don't know everything. You don't know everything. And you want to spend a large amount of your day or a large amount of your time reading, watching some videos, keeping track of what's going on out there, finding answers to things. All right. There's a lot of smart people out there and a lot of companies that publish data, and you just need to aggregate that data. So find articles from peer-reviewed sites, right? Like Bloomberg, Wall Street Journal. I'm not here to hype up one name over another, but try to stay away from those clickbait, trashy, unaccountable places that don't cite their sources and don't date their articles. And right? Keep your eye on this crypto contagion. I think there's I think the risk is spreading, like throwing a rock in a pond and seeing the ripples spread out farther and farther. I believe this has the capacity to really tear up our market right now. China lockdowns are continuing to grow. So this is another one you want to keep your eye on. They are, when we talk about misinformation and not trusting the source, the China government itself, the entire government apparatus, is not to be trusted, right? On first glance, you can't take what they say with any value. It has to be validated, verified, quantified, and even then, they still get some shenanigans in there. So when headlines come out on China stuff, take it with a grain of salt. Try to give it a little bit of time to see, if it's going to be validated or not. In the last few weeks, they were doing these subtle little hints that they were going to, ease up COVID restrictions. And of course, they would see those China ADR names pop to the upside. And then, a day or two later, it was, oh, no, we're not reducing our COVID restrictions. Where'd you get that idea from? It's little tricks like that. There is the strike right now is a really big deal. If you guys remember, not too long ago, there was a rail strike on deck, and then suddenly it all just went away until after the election. Well, the election is gone, it's done, it's over with, and now the strike is back. This is going to be inflationary driven like you wouldn't believe. One of the things that stood out when I was reading through rail restrictions was that they were not going to ship a lot of farmer chemicals because a lot of those chemicals can't just sit somewhere, right? Like in the middle of transit. So if they start shutting down rails and a train is carrying a bunch of those chemicals, that'd be a bad deal. So the trains just won't load and won't ship those chemicals if the threat of the strike becomes elevated beyond a certain level. I don't know what the level is. That's food cost right off the bat, because if farmers can't get those chemicals at their regular cost, or if the supply starts to dry up, demand will drive prices up, drive up the cost of a farmer for his chemicals. He's going to drive up the cost of his finished product, food, grain, everything, right? Add to that inflationary pressure from fuel costs going up. They've been keeping the fuel pump prices down because of the election. I keep talking about election stuff, and I'm not against this president or the last president or the president before that. All presidents do this, right? It's just what they do. So I'm not picking on one president over another. It's just a fact, right? The sun goes up, the sun goes down. It's fact. White House manipulates pump prices during elections. It's the way it is. But the elections are done. So you add holiday pump prices with the fact that we're not doing strategic petroleum releases anymore, we're going to see more elevated pump prices. That directly affects everything else. Inflation again. So this talk about a Fed pivot, or even just dropping off of that default 75 basis point rate hikes coming in December, I would take that with a grain of salt. Sure, it's going to take a little while for these inflationary things that we're talking about to bleed through into CPI and PPI, but it is going to come through. The Fed is going to realize rather quickly that they still have a long ways to go. They're not going to want to slow down. They don't want to give this market any excuse to pop to the upside. And on November 30th, Powell's going to be at a meeting where he's going to be speaking in public, and it's an opportunity for him to perform a Jackson Hole moment. If the market continues to buoy upwards and they want to smack it down again, that'll be his first opportunity. All of this that they're doing is for wealth destruction. They're trying to kill demand. They're trying to destroy wealth, trying to reduce everything that's going on, pull money like a sponge back out of the market again. So if they continue to see the market buoy higher and they start getting these inflation readings, the idea of them dropping to a 50 basis point rate hike in December becomes a little hard to fathom, hard to imagine. So if they start pricing in what they've been unwinding, we're going to see the market leg down because they're going to need to put 25 basis points back on the table after having unwound those 25 basis points. There was some weed news for New York with a little bit of joke that went with it. You might soon be able to buy weed in New York. And then, of course, the joke was, of course, you could always buy weed in New York, but now you'll be able to do it legally. So I have to see how the strike goes. Those are three key things you're really going to want to focus on when you're checking headlines, reading articles, kind of digging around behind the scenes. Anything to do with the COVID restrictions over in China, the railroad strike, and the crypto contagion. Just keep track of those three, especially in major headlines. Yeah, that's another one. There's some oil talk coming out of Saudi Arabia, more OPEC plus discussions. So definitely worth keeping your eye on that one too. We have Fed speakers today, Bullard, George, and then some ECB speakers as well. We still anticipate that they're going to keep singing from the same hymn book. So not expecting really anything at this point that would be different from the standard statement we've been seeing. The threat would be if one of them do decide to, stand outside the group, right, and kind of raise their voice or change the tone or the topic. I don't expect that, but it's the unexpected that usually catches us, right? Continued retail sales data. We do have additional auctions, 11, 11:30, and 1 o'clock. That 7-year, normally I don't see much out of that one, but I wouldn't. In the current environment, I wouldn't take any risk. I'd still wait until 1 o'clock, probably about 1:15 before putting on your 0-day. These auctions do not get the attention that I give them anywhere else. I never see anybody talking about them, mentioning them, and focusing on them. To me, they're critical. When it comes to 0-day trades, that one bit of data is a game changer. So for me, no 0-day trade for the afternoon session until we're done with that 7-year auction. volume is within normal limits, so there's really nothing there to focus on. We just turn that off. We're in a pivotal moment right now, complete and total indecision. With that doji week that we had last week, we need to resolve this. We need to get out of this box. A break above last week's high will continue the bullish move that we've been in since, second week of October. And a break below last week's low will, I believe, kick off a resumption back to the downside. Right? So it's really simple right now. Break out, let's get bullish, and it'll be a continuation of, right? It won't be like it's just a 1 day, 2 day trade. It'll be a continuation up into, call it, 42, maybe 43. And if we break below last week's low, then we're going to be looking at 37, potentially 35, kind of work our way back down again, right? So very simple, easy metrics. We got to get outside of this range, and that's very likely on Friday. The holiday week, a shortened week, generally is going to cause us to get sideways Monday and Tuesday. We've got FOMC minutes on Wednesday, which could cause some violence. And it has the volatility capacity to break us out. But we need end of week close for this breakout that I'm discussing, right? Just wicking out of it today or at some point during the week won't count. We need to close outside of that range at the end of the week. So weekly close levels. If we close to the downside underneath that level going into Friday, then we'll be looking for a leg down and a resumption back to that 35-ish area, right? And then above, same thing. So I guess the takeaway on that is hold off. If you're not in any new positions, don't start any up until we get this resolution. It's usually not a good idea to start new positions in the middle of a holiday shortened week anyways. We're talking swings, right? Day trades, yeah, of course, keep going. There's nothing to hold us back on that. Speaking of sideways markets and shortened weeks, yesterday I made a statement about we're very likely just going to maintain this range for the week, or at least until Wednesday when we get the FOMC minutes. So all of Monday has so far done what it was supposed to. Into Globex, still same thing. Even last night in the fade, when we came down and tagged the lows, we stayed within the box. So all day today, that's going to be the expectation, is that we just maintain the range. But the range isn't just what I have marked here. We have to take it a little farther to the downside. Previous week's low, right there. So that's how low we could go, and we could even wick outside of it as long as we come back in again. For today, the expectation is we're just going to hold the line. We're going to maintain this range. If we look at the ADR, it gets us all the way up to 40.42. That is really close to the previous week's high. So today, and until the FOMC minutes come out, our range is actually this big, 40, 50, all the way down to 3,900. The expectation is that we're going to maintain this until the minutes. And if the minutes do not bring out anything new that really kind of freak investors out, we'll make it through the minutes and into Thanksgiving. There's a little bit of a danger with that. Over the holiday, they're going to parse through that data. And as we open on Friday with lower volume, markets can really move with low volume. The lower the volume, the bigger the move can be, because it doesn't take as much effort to move a market when there's lower volume. News, of course, can throw all this out the window. So if something comes out with, the Russia-Ukraine war, with something to do with the energy markets, crypto, or the China lockdowns, we could break this range, or the strikes. So the list of things the wall of worry is getting long, but that's the range. My base case argument is that there should be a really nice rejection point if we can get back up to Friday's high, get a nice rejection there. Should we break through that, then we have that Wednesday double top in the Globex as a nice rejection point. For the downside, it'll be this 236 retrace. It's right around 3940 area, 3940, 3945. It's our Globex low, basically. Should have a nice rejection there with a move back up. And if we don't get it there, then we'll focus on the previous low. The previous week's low, excuse me. That's 3911 area. It's a cog line. It's also Thursday's low. $10-day, 30-minute volume profile. We are at the point of control, and there's not a lot left back here. It's going to drop off in the next few days. We got Thursday's price action, or excuse me, Tuesdays for our Tuesday, right? Because we're in a 10-day volume profile. So as we move forward through the day today, we're going to lose this data from back here. But it's really Thursday's data that's keeping our volume profile this big, right? Once we lose Thursday's, our volume profile is going to be a lot narrower. Notice if we break to the downside, that Thursday low that I talked about, 3911 cog line, that's the last line of defense, and it's not very much. So a very mild volume shelf there. Certainly nothing that I would lean on as support. Might get a first touch bounce. I would almost anticipate that. And if I get a chance, I'll trade that. But it's just a first touch bounce. It doesn't owe us much. And if we break through it, it gets very shallow. And we can move through shallow areas really fast, like we did here. So a break below 3911 can send us down to 38 very quickly. There's a little bit of structure around 38.25. So if you take it short, be ready to kind of defend your position around that 38.30, 38.25. Remember, they're going to try to front run you, right? So, even getting out at, say, 38.30 wouldn't be a bad idea. We don't have any point of control on a day-to-day basis to bring forward. And the value area low from yesterday is really close to the low of yesterday. So there's really, for me, no reason to carry that one forward either. You could, if you was to study volume profile, they would actually recommend it. But I would focus more on the low of yesterday itself and less on that value area low. We also have one of my pivot points at 39.38. So, if we got into that area, the low of yesterday added with this 39.38 added to also the value area low gives us a nice structure down here. Remember, when you're dealing with pivot points, imagine you're using a fat, dull crayon, not a very sharp pencil. All right, so we're up slightly this morning, 0.25%. Got a nice little double top coming in here. Depending on how far you look back, right, it's be a triple top. We really don't have a lot of expectation for any kind of follow through without news, right? So we want to time this move in with any kind of news. That weekly pivot point, as long as we're below it, we want to consider bearish positions, but that has to be taken with a grain of salt, because if we're moving back to the weekly pivot point, then obviously, the idea of staying short doesn't work, right? It doesn't fit. It's more of a posture and a bias than it is as a trade logic. Still, it's also a pivot point. So if we do break through our own Globex high, which is really close to the RTH high of yesterday, then weekly pivot point at 39.78 is going to be first touch. We get through that, 39.82, which is the real high of yesterday, will be our next target. All right, so we're getting the dollar trying to work its way back up again. It's holding above that 105.5 area. It's kind of an important level at this point. On the week, we really want to focus on this thing not making a big extreme move like we had the other day with that really big red candle. You want to keep your candle line measurement on there too until we resolve those levels. We're looking at weeks to complete any of these lines, but the one that I wanted to focus on here is the 50% line. We need to maintain below that level on a close, not just, on an intraday basis. Back here, we had a really big candle. We had a 50% marker. We got through that marker, but rallied back up by the end of the day. So the breakdown didn't really count. It wasn't until later when we closed below it that it became more important, right? So right now we're below that 50% level. We need to stay below it on the close. And if we can do that, then it gives the market, the S&P, the freedom to move bullishly if it wants to, right? This isn't going to make us go up or down. But with the dollar maintaining below that level and preferably continuing to move lower from there, then it'll give our market the capacity to move higher, right? It's one less weight against the market. But we don't want to see anything extreme, right? So no more big, crazy days, big, crazy candles. Of course, these are weekly candles. So, it's how far we travel in a week. we could continue to move up in the dollar for the rest of the week as long as we just stay below that 108.77. It's going to be kind of the line in the sand. Had a lot going on in oil yesterday. Had a really nice fake out, right? In XLE and XOM, all of those. So a beautiful move down and then awesome recovery. It fits perfectly into what I was talking about the other day when we're talking about energy names like Exxon or Chevron, Halliburton. Energy as a sector might be doing good, might be bullish, might be moving up, but this is a stock market. So the stocks of the companies that are in this market are going to get whacked or they're going to go bullish just like the rest of the market does. And yesterday when everything flipped and we started getting all those bullish flows, everything started moving up, including those energy names. This move in US dollar CAD lines up perfectly with that move that we had in XLE inverted, right? This went up, XLE went down. I pointed out as an alternative market, right? We talk about all the time, if you're trading something, don't just look at the one thing you're trading, right? You're in Facebook, look at the S&P. You're in Google, look at the NASDAQ. Look at something other than just the one thing you're trading. So with XLE, with the energy names, something worth watching is US dollar Canada. As a proxy, this correlates very often with energy. Energy correlates really often with commodities, food, and everything else. We still have Bank of Japan maintaining above that 139 level. I added some really big, thick lines here. I had found this chart over the weekend on FX website that showed previous Bank of Japan interventions. So the 1998, which when I started digging into it, there was a lot of really great articles to read about what happened back in 1998. But there was a Bank of Japan intervention then. And then in, of course, September of this year, the 195 level. And there was another one in 2002. So I added those critical levels. The main ones, though, that have been reactionary for us are the quarterly levels and the monthly levels. Right now, that monthly is holding as a support. We have that bear pennant or bear flag breakout. It's a failure. Say it the way that makes sense. Bear flag failure or bear pennant failure. It's one of my trade strategies that I really love. But it's topped out. It's already given us what it owes. And it's very unlikely we're going to see reciprocation all the way back up to the 145. But that rejection yesterday tied in really nice with the move in the dollar. And the move upward, that breakout that we had, tied in really nice with the move in the dollar. So, I think we're all in an agreement that when the dollar moves up, the S&P and the NASDAQ quit moving up and very often go down. Not like, say, a teeter-totter, one goes up, one has to go down. Just more of the idea that if one goes up, we're very likely to see the other one fade. So if we know that about the dollar, trying to understand when the dollar is going to go up or down, or why the dollar is going up or down, will help us focus our trade opportunities on the S&P and the NASDAQ, which is why I'm pointing out US dollar Japan. The other one would be US dollar Canada, or excuse me, US dollar China. I have this very large, wide open space where I don't have any monthly levels to focus on. And, you know, there's always smaller time frame levels that we can kind of hit on, but the smaller the time frame, the less power the pivot has, right? The less trust we have in it. So right now we're going to be looking for US dollar China to hold this 7.14. If it breaks here and continues to move to the downside, that should be reflected in the dollar also, making that same move to the downside. And that should pop the S&P and the NASDAQ to the upside. If this holds as support and we begin making our way back up, we're going to be looking for the dollar to also begin making its way back up, and we'll expect the S&P and the NASDAQ to break structure, break our Globex low, and make that move to the downside. But again, everything is supposed to hold the line until at least the FOMC minutes come out, preferably all the way into Thanksgiving, but you know, right in front of those FOMC minutes, it's hard to say. The miners are up, energy, gold, oil, OIH. ExxonMobil, oil and gas ETFs, Bitcoin ETFs. And below the Bitcoin, the rest of these are less than 50% or less than 0.5%. So there's more names that are up, but they're just not up enough yet to match the qualifications. The monsters of tech yesterday were kind of going against the rest of the marketplace. Before I get there, I guess we'll go ahead and finish this. So the S&P just got above that 3-period daily EMA. When we're above that, we're bullish. When we're below it, we're bearish. A crossover is a bullish signal. So we got the S&P, the Russell, and the Dow all above that key level. But the NASDAQ is not above that level yet. So we need the NASDAQ to get above that 3-period EMA. You can use EMA, SMA. It's such a small moving average that I like to use the EMA on that one. But, you know, like we've talked about before, you're probably, if it really matters, you're probably better off just using both. If it doesn't matter to you, pick one. All right, so here we're looking at the NY Fang. This is a representation of the monsters of tech, although it does have other names in there too. Baidu, Baba. I don't think they've rebalanced it yet, so it probably still has Twitter in it. But they'll get around to rebalancing it soon enough. They'll take Twitter out of it. And I'm kind of interested to see what they're going to do at that point. If they'll add another name or they'll just keep it, you know, without Twitter in it. Get rid of the financials for a moment. Put the XLK there. Technology itself wasn't as weak yesterday as the monsters of tech were. If you look at what was going on in the S&P yesterday, things really didn't get out of control on either side. We had a lot of names, kind of a 50-50 spread. So the advancing minus the declining issues stayed really tight together. In the NASDAQ, we stayed completely in distribution all day long. And if you look at the cumulative tick yesterday in the NASDAQ, it was just all negative all day. And that makes sense because that cumulative tick was really responding to all of those names that were short yesterday. And it just didn't have any positive to bring this thing back around. The financials, on the other hand, nearly made an inside day breakout or an intraday breakout right towards the end of the day. It didn't make it, but it sure gave it a good run. So we want to continue to focus on those financials, especially with this situation going on in the crypto space. Seems a little weird that they're up like this with everything going on in that crypto arena. We got a H pattern on BITO. This is a Bitcoin ETF. It's pretty liquid, all things considered. So we're going to be looking for this to come out of balance. A double bottom like this will be a really good double bottom if it breaks the current low and goes beyond that low and then comes back up. That'll trap a bunch of shorts and then squeeze them on the move back up. And of course, you got to buy to close. Their buying will add to all the other buying, and you get that big explosive move to the upside. Had a really nice run in Nucor yesterday. If you look at it on the daily here, kind of watching this morning to see, if it's going to fall back in or not. All right, I got a structural level on Tesla at 166, but we've rallied this morning in the pre-market. We're up to 170.85. So we're already getting a little bit of that rebound. We were just talking about a double bottom and how we wanted to go lower than the previous low first before rallying up and squeezing those shorts. But just because it's a double bottom doesn't mean that it has to rally up, right? If you look back at this previous double bottom where we set the low here, came up, rolled over, broke lows, started to go lower. Obviously, we didn't get a follow through. We didn't get some big rally back up. We got some levels to focus on this morning for a gap close. The gap will be closed at 180.19. 180 is good enough. There's no reason to worry about that 19 cents. But to get there, we got to get through the pivot point at 175.85. The idea is we closed here, we opened here, and then we closed here. And right now we're up in the pre-market to around 170. We're sitting in here. Keep track of the 50% mark on this candle. If we remain below that, then we'll be looking for, a pre-market rally up, a gap up, hit our head on that resistance near the open, and then continue the move to the downside. And that's if we expect this to continue this downward move that it's been in. So the level that I had, we're there, 166.11. We hit that in the pre-market. We've made our move back up, or we've started to make our move back up. You can see there's a lot of area here where we moved through it really fast. There's likely not a lot of volume resistance up there, but we can check that. Come over to the volume profile, look at it on the daily. We have a VPOC worth carrying forward from 178, but that's a long ways off. Otherwise, we are above yesterday's point of control. If we were to begin working our way back down, it might be worth marking and carrying forward, but we've already went through that zone. And once we've gone through it, they really don't have a lot of value. I mean, it's worth marking and just seeing, how it responds when we go through there, but I wouldn't expect anything from it. Apple continues to be more valuable to us than the VIX when it comes to gauging what's going on in the broader market. 148 is basically that line in the sand. I heard someone recently referring to this as one of the generals of the market. I usually call it like the darling of Wall Street or something like that, right? It's Wall Street's baby. Everybody loves it. But if everybody quits loving it and we finally start to see redemptions in this, there goes the market. So there is that benchmark of 148, but because of last week's moves down into that 145, I'm going to go against what I've been hearing everybody else say, calling that 148 the pivotal line in the sand. And I would move my line down to Thursday's low. As long as Apple is maintaining above Thursday's low, then it's not falling apart, right? I mean, obviously, it's holding the line. just for some round numbers, we'll call it 145.5. So if Apple can maintain above 145.5, then the rest of the market can not fall apart. S&P, NASDAQ, they'll be weak if this doesn't rally, but they won't crash and burn if this doesn't get below that 145.5. So if you see the S&P and the NASDAQ testing their lows, remember we're expecting it to hold the line. Those are opportunities to run the trade back up. We're going to be playing a range-bound market plays. So not breakouts, but breakout failures. If we see the market trying to break down, look for that reversal to bring it back up again. As long as Apple's maintaining above this 145.5, then I don't see the rest of the market burning. Same can be said with Microsoft. The line I've heard from a number of places right now is that 239. And those levels on Apple and here, it's not that those people are wrong. I'm not saying that. The time frame that they're using, right? If you look at the curve for the time frame, they're in a much, much higher time frame. Of course, those higher time frames have more structural value, but we're looking at flash crash metrics and short duration intraday trading activity. So in the big picture, looking for, swing trades, those key levels fit just fine. Looking for some more nuanced trading activity, I would say Microsoft below 237, probably 237 flat. Let's see where that puts us, and then yeah, it's close enough. The round number works, 237 flat. As long as we're holding above that, the market's not going to crash and burn. Amazon very nearly has the gap closed. We're up slightly this morning. Should we get weak, we're going to be expecting that 89.5 to get tagged. It'll become a magnet. The rejection point for Amazon to the upside, my first target would be where we opened yesterday. And if we don't reject there, then the high of yesterday, $95. So 94 first rejection, 95 would be the second. If we get above 95, then obviously the idea that we're going to close that gap is just off the table, right? And we'd start focusing on all the other pivot points on the move back up. Remember, the base case argument across the board is that we're going to hold the line. So, things like Tesla yesterday continuing that breakdown, and, Amazon, at least through the morning, continuing that breakdown, kind of went against the grain. But by the end of the day, we had that rally because everything's just holding the line. So that's our base case argument. The line, however, is a little different for every market. Some of your best plays between now and Wednesday's close are going to be rejections off of previous day's lows and or previous day's highs, using Thursday, Friday, and yesterday for those benchmarks. Facebook, for an example, I know we're supposed to call it Meta, but it's still Facebook to me. That 109, even if we do break down below that 109, we'll call it 108.50 if you want. We're still going to expect this to maintain the line. So a wick down or a breakdown intraday should recover and come right back up inside the box. If it doesn't, then I'd follow it through with the other monsters of tech and see if the rest of them are breaking down as well. The more likely situation is that we're going to get a TRB, a trendline breakover, and a reciprocation back up, pivot points from 112, 114, and then 117. Some really ugly price action here on Goldman Sachs, but 375 be a pretty clear level line in the sand. This ties in with those financials that I was talking about yesterday, making that play for a breakout. So with this one, I would be looking for a rejection on yesterday's intraday high, or excuse me, Friday's intraday high. We get above that 383, then we could focus on 386 and then 390. That would still put us back to the top of this range again, though, right? Remember, it's just hold the line. Really tight price action in NVIDIA. With yesterday being all tightly compressed like that, the capacity for a big move starts to become more likely. I would like this to hold at least into Wednesday with this really tight price, because the move on Friday would just be, oh, that would just be very sexy. I don't think we're going to get that, though. So a break above yesterday's high, we'll target that 160. We've already got enough compression at that point that 160 is not reaching, right? We're not overreaching to get to that level. Of course, we do have some trash to work through, but it's totally doable. More likely, however, is that we wick outside the box, or we just straight up reject without even getting out of the box at all. And we make our way back down. We just kind of maintain that line, wicking out a little bit lower, a little bit higher. There's the strategy called the strat, where Rob, as I think his name is Smith, Rob somebody, talks about price aggregation. Really threw me off when he used that word. Price aggregates. And in his descriptions that he would give, he would show where price would make these moves lower, maybe a little bit higher, and then a little lower again, and then a little bit higher. And what you end up getting is like this megaphone pattern. And you're just looking for price to finally break that. So kind of the same thing here with NVIDIA, with it being really tight like that. It's already started. We have that first wick down. We're now going to be looking for at least that first wick up. Now, how many wicks you get before it breaks out, or, how far it's supposed to go before it finally breaks out, there's a whole lot more to it than what I've covered here. It doesn't have to just wick out. It could just break and run. I think it's a little too far away, but we still have that gap to close. And the first step would be to get to $92. So we're at 95.5 here on Google, 92.25. We would have to get through this trend line. And then we've got this price action here to deal with. So, it's unlikely that we're going to see the move today, especially with everything else in that hold the line status that we've been talking about all morning. And if you think about how much everything has rallied this morning and how this really hasn't, it hasn't rallied by much at all. It closed at 95.6 and it's at 95.8. And for Google, I mean, that's nothing. We're talking 20 cents. So base case argument is it tries to rally up, bumps its head at 96.5. And then we roll over and continue to make that move to the downside, holding above 94.5. Since the argument is still base case, we're going to hold the range and not really break down across the board, especially in a lot of our monsters of tech. Intel has the opportunity today to reclaim a lot of that candle from yesterday, and it's got reasonably decent options. It's not an overly expensive company. It's got, liquid options. It's even got shares that you could add to the trade, right? Like just straight up selling puts without having to be in a put spread. If you can cover, owning 100 shares of a $30 stock. But a nice little reciprocation trade. If we can rally back up, say below Thursday's low, or I guess that's Friday's low. Yeah, Friday the 17th. If we can rally up inside of that, maybe see a run back towards 29.5. Looking for a red to green, basically. But I mean, this looks really weak. So the only reason I'm mentioning a long is because if we're talking about holding the line, there is no other line here for Intel except for way down at around 27.5. That wouldn't be holding the line. That would be just straight up breaking down. And we're not expecting anything to really break down. That's not a great argument for taking a trade, right? My argument would be watch this for an opportunity to trade it. Don't just run out there and trade the darn thing. XLE continues that reciprocation back up. Nice rebound yesterday. It's a perfect example of why using the 3-period daily moving average works so well. It really got extended yesterday and just came right back in again. Distance from moving average. So we had that double top fail. Now we're getting a little bit of a pullback. But if you look at the shape of this, there's your cup with a handle. So a pullback giving us that handle makes perfect sense. I don't really see, with everything else going on, that we're going to come back down and revisit these lows. There's analysts right now calling for 67 in crude, right? That would be, WTI, but we really can't trade WTI. So you can look at USO, but USO and crude, neither one of those is XLE, right? Don't make that mistake of lumping it into the same category. The top names on the list this morning, XOP, USO, and XLE. 3 energy names altogether. Behind that, silver, then the commodity index, which has 40% of those DBA, DBCs, 40% of this is energy. So it makes sense that it's up this morning with the energy names. Those China names, KWeb is down 1.6. We had talked about the idea that the China state banks were ordered to buy these ADR names and that we wouldn't know when the flow was going to dry up, right? We knew they were told to buy, but how much? And, when was that going to end? This is another day now where we've had KWeb down. So it's starting to look like either that buying is on pause or they're wrapping up and they're getting done, right? That it's about over with. But this is just a basket of stocks. So you might be better off looking at the individual names. Baba, Baidu, JD, PDD. They're all, we can go back and see if I missed one, but most of the pattern looks like they're inside that really big green candle. That's your controlling candle. So as long as we maintain inside of that, we're not bearish. We got to break outside of that level first. And same thing for bullish. If you're looking for a bullish play in these names, we got to get above that big green candle. We're basically flat in EEM this morning, but it's another one that we use to monitor those China names, right? This is another reflection of China through emerging markets. Same thing, big green candle. It's the one in control. With the slight rally that we have this morning, that we had, we don't have it now. We're below the close at this point. We're going to be looking for this to hold the line. A breakdown below on emerging markets, and we could start to see a lot of those names, those China ADRs, really start to fall apart. That's what I got for you guys. Be careful, be safe. I will see you all tomorrow.